Today, I want to consider one of the theory aspect of first chapter, partnership accounts. I want to consider the theory about maintenance of capital accounts of partners in a partnership firm. Just observe on the screen. Now first I will read this theory for you, explain its contents. There is no much difference between accounting of a sole proprietor and a partnership firm, except that profit of a partnership firm are divided amongst partners, for which profit and loss appropriation account is prepared. That profit and loss appropriation account is an extension of the profit and loss account. So this profit and loss appropriation account is prepared over and above the trading account, profit and loss account and balance sheet. So in sole proprietorship final accounts, we prepare trading account, profit and loss account and balance sheet. In partnership, we prepare the trading account same as sole proprietor. We prepare profit and loss account same as sole proprietor. But here in partnership, there is a question of distribution of profit. For that, one more account is prepared, that is known as profit and loss appropriation account, which is an extension of profit and loss account. So profit and loss appropriation account is the additional matter to be incorporated in the final accounts of the partnership firm. The balance sheet is also prepared the same way in partnership firm as we have done for sole proprietor. There will be a separate capital account and drawings account for each of the partner. The number of capital accounts and drawings account will be equal to the number of partners. Now in case of sole proprietorship, there is one proprietor, so one capital account. One proprietor, then his own drawing account. But in case of partnership, there are more than one persons who are the owners of the business. So if suppose that there are three partners, then there are three separate capital accounts. When there is a three partner, then there are three separate drawings account. So this is the difference that occurs in partnership accounting as compared to accounting of a sole proprietorship. Except these two, everything is same in case of sole proprietorship and partnership. Now I want to go into the details of maintenance of capital accounts. Capital accounts of the partners that I want to discuss. Just observe on the screen. I read for you. A capital account of each partner is prepared in the books of the partnership firm to record partners' transactions with the firm. The transaction resulting into an increase in partners' investment in the firm are shown on the credit side of capital account, and the transaction resulting into the decrease in the partner's investment in the firm are shown on the debit side of capital account. Now see, capital contributed by a partner in a firm is an investment by a partner in the firm. Whenever the value of his investment goes up because of profit, etc., the capital account of the partner is credited. And the reasons because of which the investment of a partner in a partnership firm decreases just like because of drawings and interest on drawings, etc. Then, for those matters, partner's capital account is to be debited. A separate capital account is opened for each partner, and the transactions by the firm with the partner are recorded in the respective capital account of the partner. Partner's capital account can be maintained in the books of accounts of the firm by one of the following methods: fluctuating or floating capital account method, fixed capital account method. Now in this capital account, the transaction between partner and the partnership firm are recorded. Now we are recording this capital account in the books of the firm. So when partner is a receiver, partner's capital account is to be debited. When partner is a giver, partner's capital account is to be credited. So this is also one of the criteria for recording debit and credit to the partner's capital account. The first criteria, the investment of partner increases, the transaction that increases the investment credited, or the other criteria, if the partner is a giver, then also the partner's capital account is to be credited. Similarly, when there is a decline in the value of investment of a partner, partner's capital account is to be debited. Or when the partner is a receiver, then also the partner's capital account is to be debited. Now there are two methods of preparing partner's capital account. One is fluctuating or floating capital account method and fixed capital account method. Now to explain this concept, first of all I will take one small illustration. I will prepare capital account under both the methods and then I will discuss the theory thereof. Observe it. Now see. Show how the following items will appear in the capital accounts of the partners of Nirva and Siona when the capitals are fluctuating and second option fixed. Capital at the beginning of the year 1,20,000, 80,000. Additional capital brought by Siona 20,000. Drawings of Nirva 20,000 and Siona 10,000. Interest allowed at 12% on the capital 14,400 and 9,600. Interest charged on drawings are 1,500. Partner salary, Nirva gets a salary of 7,200. Partner's commission 7,000, Siona gets a commission of 7,000. Share of profit, Nirva's share of profit is 15,000, Siona's share of profit is 12,000. Now this is the various amounts that Nirva and Siona availed from the partnership firm as per their agreement. Now I want to prepare a capital account from these details, one under fluctuating capital method and second under fixed capital method. First I solve the sum by fluctuating capital method. There are two partners, so two capital accounts are there. One is Nirva's capital account and second is Siona's capital account. They have contributed 1,20,000 and 80,000 in a business. So they are the giver, credit the giver. Capital contributed by partner, partner is a giver, credit the giver. So 1,20,000 and 80,000 is recorded on the credit side as balance brought down. The additional capital brought by Siona, 20,000 on the last day of the year. So she brought 20,000. Partnership firm receives a cash of 20,000. Siona is the giver, credit the giver. So Siona's capital account is to be credited with 20,000. Now drawings are 20,000 and 10,000. Nirva has withdrawn. Nirva is the receiver. Siona has withdrawn. Siona is the receiver. Debit the receiver. So drawings amount withdrawn by a partner from a firm is debited to the capital account of a partner. Observe it. Nirva's and Siona's capital accounts are debited with the amount drawn by them, that is 20,000 and 10,000. Now this is a capital contribution on which interest on capital is granted. interest is always added to the principal sum. This is a principal sum on which 12% interest is to be paid. So 1,20,000 into 12%, 14,400. Interest is added to principal sum. So this interest on capital will be credited to capital account. Similarly, interest on drawings 1,500. Here drawings are recorded on the debit side. Interest is always added to the principal sum. So interest on drawings will be debited to the partner's capital account, while interest on capital will be credited to the partner's capital account. The reason is interest is added to the principal sum. This is one way of explanation. So here 14,400 and 9,600 credited. Interest on drawings are debited to the partner's capital account. Now salary to a partner. Now when partner gets a salary for active work in the firm, his investment in the firm increases. When the investment in the firm increases, partner's capital account is to be credited. Same way for salary and commission, which partners are entitled to, by that their contribution in a firm, either in the form of funds or services, increases, and that's why partner's capital account is to be credited. So 7,200 credited to Nirva's capital account, commission 7,000 credited to Siona's capital account. Now at the end of the year, whatever the profit left after giving all these things is a divisible profit that is distributed between partners in the ratio of 15,000, 12,000, that is 5:4. And this profit also increases their investment in the firm, so it is credited to the capital account of the partner. This is how capital account gets maintained under floating capital method or fluctuating capital method. Now after recording all this transaction, I would like to find out the balance of capital account. Total of credit minus total of debit. I will get the closing balance of capital account that shall be reported in the balance sheet liability side. So total of credit side of Nirva 1,56,600. From that you are required to deduct 21,000. So you will get the balance to be carried forward 1,35,600. Same way I want to work out for Siona. 1,28,600 is the total of credit side that I write on the debit side. From that I will deduct 10,500. So balance carried forward is 1,18,100. This is how the capital account gets prepared under fluctuating or floating capital method. This balance carried forward is balance brought down. Now I want to consider the same details and I will be preparing capital accounts under fixed capital accounting method. Observe it. In this method, every partner holds two capital accounts. One fixed capital account of Nirva and second current capital account of Nirva. Here there is one fixed capital account of Siona and second current capital account of Siona. Now, I have already designed the sum for you. This is the sum. This opening balance of fixed capital account and the capital contributed, which is of permanent nature, will be credited to fixed capital account. So 1,20,000 and 80,000, which is a permanent capital, and the additional capital introduced 20,000 is also presumed to be permanent. So it is credited to fixed capital account. Now this drawings during the year will be debited to current capital account. Interest on capital will be credited to current capital account. Interest on drawings is added to the principal sum. Partner's salary and partner's commission, they add to the investment of a partner in a firm. They are the giver of services. This is the annual services that we have received from a partner. And the annual transaction, which are relevant to the profit for the year, which are relevant to the profit during the year, is to be recorded in current capital account. So salary to a partner, current capital account credit. Commission to a partner, current capital account credit. Annual profit distributed to a partner is also credited to current capital account. Now I want to find out the balance. The balance of fixed capital account 1,20,000 and 1 lakh. This is the balance carried forward of fixed capital. This is more or less permanent capital balance. Now this current capital account is prepared to find whether the annual transaction with the partner has resulted into an ultimate contribution in the firm, or the withdrawals of the partner is more than annual earning. So here I prepare the balance of Nirva's capital account. Total of credits is 36,600. From that 21,000 deducted, so balance carried forward 15,600. So profit element, income element credited to the partner's capital account is 36,600, against drawings and interest on drawings are deducted. So this is a 15,600 is a fluctuating, is a rotating capital contribution in a partnership form. There can be a debit balance in case of current account also. So 28,600 minus 10,500, this is the current capital account balance carried forward, and that will be reported in the balance sheet. This current capital account may hold a debit balance also, while in case of fixed capital account, generally we never find the debit balance. Now after explaining this illustration, let me describe in detail the fluctuating capital account and fixed capital account. Now read this. Fluctuating capital account method. What have I explained to you in illustration? That I write in here. Under this method, one separate capital account is maintained for each partner. Each capital account is credited with a capital contributions by a partner, 1,20,000 and 80,000. Capital contributions by a partner with interest on capital is also credited. Salary, commission and share in profit. Salary, commission and share in profit are also credited. And each capital account is debited with the drawings and interest on drawings and sharing loss. Thus, balance of capital account at the end of the year fluctuates, is different from opening balance of capital account. So this method of capital account is called fluctuating capital account. Here the opening balance is 1,20,000, closing balance is 1,35,600. So it has fluctuated. Here the opening balance is 80,000, closing balance is 1,18,100. So it has changed, fluctuated. That's why this capital account maintenance system is known as fluctuating or floating capital account system. Now I want to discuss or describe fixed capital account. Under this method, two capital accounts for each partner are maintained, known as partner's capital account and second partner's current account. Now partner's capital account is known as fixed capital account. Transaction relating to the original and additional capital contributions are credited to the capital accounts, while withdrawals of capital as per the agreement is debited to the capital accounts. This normally occurs in case of reconstruction of a firm. What is reconstruction of a firm that we are going to study later on? Here I have prepared fixed capital account. The initial contribution and the additional contribution is credited and the balance is worked out. This fixed capital, see, opening balance 1,20,000, closing balance 1,20,000. Opening balance 80,000, closing balance 1 lakh, but additional capital 20,000 is of permanent nature, so credited. This is how fixed capital account gets prepared. This I have already illustrated previously. Now read the information. partner's current account, the transaction with the partner in respect of interest on capital, salary, commission, share in profit. Share in profit to a partner as agreed is credited to a separate capital account that is known as current capital account. While drawings and interest on drawings, or if there is a loss distributed to the partners, that is also debited to the current capital account, that appears on the debit side of current capital account. When the capital accounts are fixed, there is another account that we prepare, that is current capital account, and this is how the details are recorded, and that has been described over here. Now, I have tried to explain the concept of fixed capital, fluctuating capital by taking one illustration. I feel that you have followed. Now, after this discussion, next is the detailing of profit and loss appropriation account. But at present, I just conclude the discussion about the capital accounts maintained in case of partnership firm. Thanks to all of you.